Kia ora and welcome to episode 47 of Bridge Talks Business with Milford. As always, markets watch the US economy very closely. It's a vital organ of the global economy. Our fortunes are all tied to its fortunes. And latest job creation numbers have some nervous. The Fed, like our Reserve Bank, is poised to step up to the plate with cuts to help out. Mark Riggle is our man in the hot seat today. His take, as always, is an interesting one. We'll get to that shortly. First, here's your top 5 business bits. Number 1, the jury's out on America's labour market slowdown. Data last week revealing an ongoing cool down, but this also happened a year ago and then rebounded in the end of the year. History may repeat, but alarmingly, it's now close to net negative job creation. More with Mark on that shortly. Number 2, healthcare was the only sector consistently growing jobs. Most others were shedding. Mind you, workers aren't yet worried about job security, but if they are out of work, they're finding it harder to get a job. Number 3, unsurprisingly, the weaker labour market has prompted investors to reprice expectations of Fed rate cuts. They're now expected 3 times this year, a quarter point at each of their meetings. Number 4, over in Australia, second quarter GDP was surprisingly strong there, showing the resilience of the Aussie economy. Why? Well, mainly stronger households. Consumption up 2% year on year. Rate cuts, plus throw into that mix house prices still rising. And number 5, this week we look ahead. US inflation data. Will we see signs that the tariff impacts are growing there? And we have retail card spending numbers out of New Zealand. Are we hitting the shops? Markets looking for signs of life. All right, time is money and no one likes wasting that. So let's crack into today's episode. I'm going to be joined by Mark Riggle, Portfolio Manager at Milford. Mark knows what he's talking about. We've had him on the show plenty of times before. Just a reminder, this segment is informational only and should not be considered financial advice. Mark, welcome back.
Great to be here.
Long time no see.
Yeah.
In the meantime, we've had jobs numbers out of the US, and we talk about this a lot. We look at the jobs numbers because they're a sign potentially of weakness in the economy. What did we see from the numbers on Friday?
Right, so let's put it in context. The US consumer is the strongest, biggest source of demand in the world. And so when something upsets the US consumer, we've all got to pay attention to it. So the labour market clearly is important because if people are concerned about their jobs, then they're not going to be consuming quite as strongly as they were. The numbers last week showed a pretty weak labour market in the US. You know, the number of job ads came in well below expectations, and revisions to prior months showed that actually for the last 4 months on the trot, the job creation in the US has been quite low, right? Very close to zero, in fact, over that period. So that is something of a concern.
And for the most recent month I was reading, they added roughly 22,000 jobs,
Yep.
but were estimated to add 75,000 jobs.
Yeah. So you get noisy numbers month to month, so you got to kind of zoom out a little bit because these numbers do get revised. So you got to be careful about hanging your hat on one number in particular, which is why it's good to look at the detail, look at the trend. The trend has been one of weaker job creation or job demand over the last few years, right? That's from a position of very, very strong job demand back to a kind of more normal environment. And now we're threatening to go actually below a normal environment where net job demand is below zero.
So a net negative result.
Yeah.
Okay, so why? Is this because the economy, the consumer is weak in the US, or is this more to do with tariffs and, companies maybe putting off decisions about hiring, that kind of thing?
Yeah, I mean, it'd be great to kind of put a nice bow on a reason why, one reason why that would be the case. But I think there's multiple things going on, some of which you mentioned, right? So tariff uncertainty has been a big thing. Companies just don't know, right, what their environment's going to be like for selling, going forward. Now that has started to resolve itself. We now know what tariffs are going to be. So that uncertainty is going away, and business services surveys have improved as a result, right? And so that could have been weighing on hiring, right? We had a sell-off in the stock market when company stock prices are going down, the CEOs are not so confident and hiring might be impacted. Again, we've had a rebound now, so maybe that starts to go away. There might be some seasonality with it. We saw a slowdown in jobs market 12 months ago, and then it rebounded into the end of the year. So, there's reasons to be optimistic that actually some of this weakness can solve itself and we can rebound going forward, but we're going to have to wait and see.
Could that happen again? What happened last year? We have a dip, but it rebounds, or is it actually worse now than what it was last year?
The speed of the slowdown's roughly the same.
Okay.
But the problem now is that we're much closer to zero than we were before.
Right. Okay.
Right? So there's that going on. And it's not just about the demand for labor, it's the supply of labor as well. So 12 months ago, there was a lot of supply of labor. Migration was really strong in the US, so the labor force was increasing. So that meant the unemployment rate actually went up, even though companies were hiring lots of people, right? This time around, companies are not hiring lots of people, but the immigration policy in the US is trying to actually deport people. And so the pool of workers is actually stable or even shrinking, which means the unemployment rate's not moving that much, even though the demand for workers is slowing.
What about inflation? I know we said in the business bits this morning that we're going to get inflation number this week.
Yep.
Are you expecting it's going to keep creeping up?
Yeah, well, we're looking for evidence that tariff policies feeding through into inflation, right, and feeding through into consumer prices. So there is, at the margin, some evidence of that happening already. It's expected to ramp up over the next few months as those tariffs now come into effect and companies start to try and pass through some of those costs through to prices that the consumers will see. Right, so we've got to watch for that, and that's a positive, or it's an increasing inflation force. And then you've got all the other stuff, which potentially is still slowing inflation. Will that slow enough to offset that increase from tariffs? So there's a bit going on.
And then you're sitting there as Jerome Powell, you're sitting there as the Fed going, okay, so the jobs are coming off, and the market's now expecting that they'll do some cuts this year.
Yep.
But then how do you weigh that up, balance that up with what you've just said about inflation?
Well, they've got a dual mandate, right? Full employment and a long-term inflation target. It looks like they will prioritize full employment, and concerns around weakness in the labor market will outweigh any concerns about inflation running too hot. They haven't said transitory, right? They've kind of learned their lesson and not used that term, but effectively they think tariff inflation is transitory in the same way that a VAT hike would be a transitory, one-off price rise. So they'll prioritize the labor market, and that means they're likely to cut next week at their meeting, and the market expects them to cut 2 more times this year. And in fact, the market expects them to cut close to 2.75% by the kind of end of next year, which is roughly where they think neutral is, i.e. removing all tightness in interest rates from their policy settings.
Wow. Does that mean Trump was right?
Well, there's a lot of water to go under the bridge between now and the end of next year. But, he's been putting pressure on the Fed, and I think the Fed will certainly feel that pressure. And so interest rate cuts are likely to come through.
So what's your read on the health of the economy, the US consumer and the US economy at the moment? You mentioned the employment stuff, there's the inflation. What's your prognosis?
Yeah, well, there's lots going on. So growth has stepped down this year. So we are going gangbusters last year. Economic growth in the US was like 2.5% to 3%. This year it's kind of closer to 1, maybe 1.5%. Right, there's still that uncertainty about what do tariffs do to consumers. There's some evidence that some consumers bought stuff now to stop paying higher prices in the next few months. So maybe there's been some pull forward of demand, and so we're going to have to see if this kind of soft patch continues. If we look ahead a little bit, then we get some relief coming down the track. Interest rate cuts should help things as we go forward, and then also there's some fiscal policy which should support households as we go through into 2026. So the support's coming, and the expectations are that the economy will pick up again into next year, but there's this potential soft patch that we're kind of dealing with right now.
Gold, I've been checking out the price of gold lately. Been doing not too badly. Thank you very much.
Yeah, that's right. So why is gold going up, right? It's obviously shiny, and people like accumulating shiny things. But the important thing for investors is that gold is a store of value, right? And what we've seen now in the US is that inflation has been above target for 4 years running, and will be 5 years running if inflation plays out like it's expected to. So you kind of getting to the stage where you're questioning the inflation-fighting credibility of central banks. And that being the case, you want to own things that will benefit or hold their value when inflation's running hot, right? So if the purchasing power of your currency is falling, then what can I own as an asset to kind of protect me against that? And gold falls squarely into that bracket. So the Fed cutting interest rates, even though inflation is running hot, investors are going, well, I just want to own stores of value like gold. So that's why gold's been rising. It had gone sideways for 4 months from kind of April, but now it's broken out of its range and started rising again.
Fascinating. You mentioned the central banks and their ability to actually tame inflation. This is how big of a problem is this? Because it's something that I sort of heard around the traps. But it's taken too long, or they don't actually know what they're doing, or they've gone too hard, or they've gone too soft, or both. Is this going to be a bigger problem going forward for central banks?
Yeah, I think we're in a world where inflation's going to run a bit hotter than where it was. So for the 2010s, we're in a world where inflation was running below target, and central banks did everything they could to try and get inflation back, to target. And now we're in a world where supply shocks, which includes things like immigration, is causing inflation to rise. We're not talking about the 1970s, right? We're talking about inflation running just a little bit above central bank targets, which range from between 2 and 3%, depending on where you are. So inflation running at 2.5% to 3.5%, it is a hotter inflationary environment, right? But if you compound that over a number of years, then actually it becomes a problem. So it's a little bit hotter year on year, but over a long period, then that's an inflationary environment, and that's the one we're likely in going forward, because central banks will prioritize protecting growth, right, weakness in labor markets over trying to fight inflation. So it is a bit of a different investing environment for us to think about.
Which means that interest rates will continue to be cut, which we're seeing here, and we will soon see happen in the US. What does that mean for stocks? They've been rising recently. We know they like a rate cut coming. Will we see more increases? Will it just keep going up?
Yeah, stocks have enjoyed a really, really strong run. They have obviously had a wobble in April around tariffs, and now they've kind of erased all of that loss and kind of back to all-time highs. Inflation going up is not necessarily a bad thing for stocks, right? If central banks aren't going to do anything about it. So if growth and inflation is running hot, then that's actually not a bad thing for stocks. That said, they're quite expensive stocks at the moment, so it's hard to pound the table too hard on it. And September does tend to have its volatility, as we've seen in previous years. So you've always got to be alert for these things. But the outlook for shares in general, especially if growth improves into next year, is not too bad at all.
For those who are watching or listening to this podcast thinking, well, it's America, I don't really care, what does it mean for us?
Yeah, well, for KiwiSaver, clearly, much of the investments are in US companies, because they're huge companies that are domiciled in the US but are global in nature. So you're getting access to the global economy via US shares, right? And what happens to US shares matters and will be determined partly by what happens to the US economy. So that's why it matters for KiwiSaver investors. But also, what the Federal Reserve does impact what central banks elsewhere do. So if the Federal Reserve is cutting interest rates, then that actually enables other central banks like the RBNZ to keep cutting, right? Because otherwise they'd be concerned about currency impacts. But if the US central bank's cutting, then it allows New Zealand to cut without the New Zealand dollar falling too far. So it does enable cutting cycles to continue in places like New Zealand. So that's important as well.
Fascinating as always, Mark. Great to have you on the podcast. Thank you.
Great to be here. Thanks very much.
That was Mark Riggle, Portfolio Manager at Milford, talking to us there about the US economy, about the job creation or lack thereof that's happening over there at the moment, what it means for us and what it means for our KiwiSavers, most importantly. We'll be back next week with a brand new episode. Don't forget you can like, follow and subscribe us wherever you like to do that. We love you doing so. Until next week, go invest in yourselves.